Imagine waking up tomorrow morning, opening the financial news, and seeing gold prices suddenly move in a direction nobody expected. Investors start asking the same question all over the world. What changed overnight? Was it a crisis, a political decision, or something happening quietly inside the global financial system? The surprising truth is that many of the biggest moves in gold don't start with wars or breaking headlines. Sometimes the real trigger is something much quieter but far more powerful: the strength or weakness of the US dollar. And when the dollar moves, gold listens. Before we go deeper, if you enjoy understanding how global money, markets, and gold really work, make sure you like this video and subscribe to the Gold Report. This channel is all about explaining the forces that move gold prices so you can stay informed before the market reacts. Now think about this for a moment. The US dollar is not just the currency used in the United States. It is the backbone of the global financial system. International trade, central bank reserves, global commodities, and even many government debts are priced in dollars. That means when the dollar becomes stronger, its impact spreads across the entire world economy. And one of the markets that reacts the fastest to these shifts is the gold market. Gold has always had a special relationship with the dollar. For decades, investors have noticed a pattern. When the US dollar gets stronger, gold often struggles. When the dollar weakens, gold tends to rise. But the reason behind this relationship goes deeper than just a simple inverse chart pattern. Let's imagine a global investor sitting in Europe or Asia. If the US dollar becomes stronger, that means it takes more local currency to buy gold priced in dollars. Suddenly, gold becomes more expensive for international buyers. Demand can slow down, and prices may struggle to move higher. But when the dollar weakens, the opposite happens. Gold becomes cheaper in foreign currencies, and global demand often increases. This is one of the hidden mechanics behind the gold market that many casual investors don't immediately see. But the story becomes even more interesting when we look at why the dollar becomes strong or weak in the first place. The dollar usually strengthens when investors feel confident in the US economy. Strong economic growth, rising interest rates, and stable financial markets tend to attract global money into dollar assets. When investors around the world move their money into US bonds, stocks, and other dollar-based investments, demand for the currency rises. And when the dollar rises, gold often faces pressure. But confidence can change quickly. If investors start worrying about inflation, economic slowdown, government debt, or financial instability, the dollar can lose some of its strength. At those moments, gold often starts attracting attention again. That's because gold plays a very different role in the financial system compared to paper currencies. Unlike the dollar, euro, or yen, gold cannot be printed by a central bank. It cannot be created by political decisions or monetary policy. It exists in limited supply, and that scarcity is one reason why investors turn to gold when confidence in currencies weakens. Now imagine a situation where inflation starts rising faster than expected. If inflation grows while the dollar weakens, investors may begin looking for assets that protect purchasing power. Historically, gold has often played that role. But the relationship between gold and the dollar is not always simple. Sometimes both can rise at the same time. This usually happens during periods of global uncertainty. When markets become nervous, investors often move money into assets considered safe. US Treasury bonds attract demand, which strengthens the dollar. At the same time, gold also receives safe haven demand. This dual movement can surprise investors who expect a strict opposite relationship between gold and the dollar. Another important factor behind dollar strength is interest rates. When US interest rates rise, holding dollars becomes more attractive because investors can earn higher returns from dollar-based assets like bonds. As money flows into these investments, the dollar can strengthen. And when interest rates rise sharply, gold sometimes faces pressure. Unlike bonds, gold does not pay interest or dividends. So when safe investments begin offering higher returns, some investors shift money away from gold. But here is where the story becomes more complicated. If interest rates rise because inflation is becoming dangerous, gold can actually benefit in the long term. Investors may worry that central banks are losing control of price stability. In those situations, gold can regain its role as a financial safety net. Over the past decades, this tug-of-war between interest rates, inflation, and currency strength has created some of the most dramatic moves in the gold market. Central banks themselves also play a huge role in this relationship. Around the world, many central banks hold both US dollars and gold as part of their reserves. When trust in the global financial system becomes uncertain, some countries increase their gold reserves to diversify away from heavy reliance on the dollar. In recent years, central bank gold purchases have reached some of the highest levels in modern history. This shift reflects a growing desire among some nations to strengthen financial independence. And when central banks buy gold, the impact can be powerful because they operate on a very large scale. Now let's step into the mindset of an average investor watching all these forces play out. The dollar rises, gold falls, the dollar weakens, gold rises, interest rates move, Inflation changes. Economic data surprises the market. Each of these signals sends a message to investors trying to decide where to place their money. This constant shifting of expectations is what makes the gold market so fascinating. Because gold is not just reacting to today's economic numbers. It is reacting to what investors believe will happen tomorrow. If investors believe the dollar will stay strong for years, gold demand may remain limited. But if confidence in the dollar begins to weaken, even slightly, gold can quickly regain attention. History offers many examples of this dynamic. During periods of economic expansion and strong dollar dominance, gold sometimes enters long consolidation phases. But during times of financial stress or currency uncertainty, gold has often delivered some of its most dramatic rallies. For example, when financial crises shake global markets, investors often rush toward assets that have historically held value during uncertainty. Gold becomes part of that defensive strategy. This behavior has repeated itself many times across decades. Another important element in the gold and dollar relationship is global debt. Governments around the world have accumulated enormous levels of debt over the past decades. Managing that debt sometimes requires policies that influence currency values. If markets start questioning whether governments can sustain rising debt levels without weakening their currencies, gold can attract renewed interest as a long-term store of value. And this brings us back to the core reason gold continues to matter in the modern financial system. Gold is not just a commodity, it is also a form of financial insurance. When currencies appear strong and economies are stable, investors may feel comfortable holding more paper assets. But when uncertainty appears, gold often returns to the conversation. For viewers watching the Gold Report, understanding this relationship between the dollar and gold can provide a powerful advantage. Instead of reacting emotionally to price moves, you start seeing the deeper forces driving those changes. You begin asking different questions. Is the dollar rising because of economic strength? Are interest rates attracting global capital? Is inflation quietly eroding currency value? Are central banks adjusting their reserve strategies? Each of these questions reveals another layer of the story. And when you start connecting those layers, the gold market begins to make much more sense. Looking ahead, the relationship between the US dollar and gold will likely remain one of the most important dynamics in global finance. As economic cycles continue, investors will keep watching the signals coming from currency markets, interest rates, inflation data, and central bank decisions. Every shift in those forces has the potential to influence the next move in gold. So the next time you see gold prices suddenly rising or falling, remember that the real explanation may not always be in the headlines. Sometimes the quiet movement of the dollar behind the scenes is the real driver shaping the market. And that's exactly why following these connections can help investors stay one step ahead. If you've made it this far in the video, it means you're someone who truly wants to understand how the financial world works, not just follow the crowd. So I'm curious to hear your thoughts. Do you believe the US dollar will remain strong in the coming years? Or do you think gold could benefit from future currency weakness? Share your opinion in the comments, because discussions like this help everyone in the community learn from different perspectives. And if you found this breakdown helpful, don't forget to share this video with someone who follows the gold market or invests in precious metals. It might help them see the bigger picture behind gold price movements. Thanks for watching the Gold Report, and we'll see you in the next analysis where we continue exploring the forces shaping the global gold market.